Yeah, so those are our top tips for our buyer's guide and what to expect with the buying process, and just to make it easier and more informed for the buying of your first home. And now we have our mortgage specialist from Scotiabank, Michael, joining us. Thank you,
How you
Michael.
doing, Bill?
Good. How are you doing?
I'm doing good, thanks.
Good. Very good. So I got a couple questions for you, just for the people in the room here. So what factors do you look at when choosing your mortgage options for first-time buyers?
Well, I mean, one of the things that I like to do is basically you want to give the client options. I mean, you don't want to give them just one product you're looking at because it may or may not work for them. So what I generally like to do is I like to give them their options, whether they go fixed rate or variable rate mortgage, pros and cons for each. And if we're looking at fixed rates, you also want to go a shorter term and a longer term. And the reason I do that is you try and figure out the discussions with the client to find out where they see themselves from 3 to 5 years. If they're looking at moving or doing something, which is general rule of thumb, in 3 years they look at refinancing, renovating, or moving. You don't want to time into a 5-year term mortgage; it kind of makes them feel trapped. But
Yeah.
that's generally what I try and do for them.
Okay, fantastic. Also, so since the stress test was implemented in January of 2017, what changes have you seen since that's been implemented?
Well, I mean, it's the biggest thing is happened. It's taken about a year and a half for this new rule to really come through the whole system in general. Right off the bat, the biggest thing was that the stress test basically took away 20% of an individual's purchasing power because we were no longer allowed to qualify the individual at the 5-year discounted rate. We have to qualify everyone now, whether you're doing a high ratio mortgage or a conventional. Conventional meaning putting more than 20% down or 20%. But we have to qualify at the bank rate, which is 5.34%.
Okay.
Now, you can see the difference. So for instance, today, if you're looking at a 5-year discounted rate of, let's say, 3.1%, let's say, they could get 400,000. Well, now you're going to qualify on that 5.34.
Yes.
So basically, you're adding about $500-600 a month to that payment. So it
Yeah.
requires one of two things: smaller house. You either need more down payment, or if they have debt, you need to look at getting some debt paid off before you can get that same house. So we're starting to see people realize they're starting to fall in line a little bit in terms of they understand it's there, and basically, again, it just goes back to before coaching them, letting them know what they need to get to a certain point.
Okay. Yeah. Very good news to know. So also, people are kind of aware, they have this idea of proposed lending changes coming this upcoming fall. Can you shed any light on that?
Yeah, the most recent one is the from the Liberal government. Basically, it's the First-Time Homebuyers Incentive Program. It's a shared equity program that all three mortgage insurers, CMHC, Genworth, and Canada Guarantee, they're all buying into it. Like a couple of points are, first of all, it just allows first-time home buyers with a minimum down payment to possibly have a larger down payment to help lower their monthly costs, monthly mortgage payment, right? The general, from what we've heard from this new rule is coming in fall, is that it's going to roughly attract or affect 100,000 people over the next 3 years.
Wow.
So it's not a whole lot of people considering the size of it, but it's a small sample size, right? The other big thing is this mortgage incentive program. It's not something that they have to pay. It's not like a loan where you end up paying a monthly payment on. Basically, the shared equity program is done until you sell your home. And at that point, then that shared equity program will be paid off through the equity of the sale of the house. And then finally, the last few things that we do know is that the incentive program is looking at shared equity for like the insurers would kick in up to 10% on top of your 5 if you're looking at building a new home. And if it's an existing home, then you're looking at 5% on top of your own 5. But they have and it's only a home high ratio program where the individual has to have a minimum of 5% of their own.
Okay. Yeah. Good to know.
Yeah, but there's more information coming out as this rolls along. So.
Yeah. Awesome.
What do you think are some of the disadvantages to that?
Well, my only concern, and this is me personally, my concern is that what happens if the equity's not there in the property once they have the mortgage paid off and everything else, and there's not what what are the ramifications? How do they take the shortfall, or what amount hasn't, or the shared equity program? What happens if there's not enough there to pay it off? What happens to it? Or does the individual have to take out a loan to pay it back, or what? So, I mean, there's been a lot of other theories in the mortgage industry that may have done a better job or a similar job.
Yeah.
One of them thought was maybe for first-time home buyers bumping that amortization up to 30 years as opposed to a 25-year amortization, and maybe charging an extra premium on that. But I mean, there's a lot of different things. The government of Canada, the polls has also said that banks in general need to also be looking at offering more incentives to help get the first-time home buyer into the program, into buying a home, right? So that's pretty much it.
Yeah, lots of moving parts, but we'll see come the fall where it actually ends up.
Well, hopefully sooner,
Yeah. I guess one last thing is, what tips do you have for first-time home buyers? What are they coming to you that's valuable for them to know?
Well, I mean, everyone's probably heard this. You've probably heard it many times as well. Being a realtor, ideally, what you want your client to do is you want to come in and pre-approved, not pre-qualified. And I'll explain the difference between the two. A pre-qualification is if I'm sitting across from you saying, "Hey, Dylan, tell me about your income." Well, I make $100,000 a year. I have no debt, and I can do this. Okay, well, you're approved for $500,000. Let's say. Where a pre-approved comes in is we get the concrete facts. We check your credit. We verify your income. We verify your down payment to make sure you have everything. All that is taken care of so that when we offer you approval, we're saying, Dylan, the bank has approved you as an individual for this mortgage. All you need to do is go provide the house and the property. And that's the biggest thing. And the important thing with that is when your client's pre-approved, you as a realtor will know you're not looking at a huge spectrum of price ranges.
It solidifies what we can accomplish.
Exactly.
Properties to look for.
Exactly. And then it also allows them, and then it keeps them within their comfort level as to what type of mortgage and how much of a mortgage and what their payment will be going forward that they're comfortable with. So.
Okay. Yeah. That's wonderful. Well, everyone and myself, I thank you for being with us, Michael.
Not a problem.
Great
Appreciate it.
information.
Thanks very much, Dylan.
Moving forward. You bet.